What's going on, guys? My name is Brad, and in this video I want to talk about a stock that is currently paying a 13% dividend yield. This is Starwood Property Trust. It is a REIT, ticker is STWD. If you want to take a look at it, I've really dived into the financials, earnings calls, news articles on this company in the past 1 to 2 weeks. So I've definitely put in well over 20 hours compiling all this, and if you don't mind just showing a little love to the like and subscribe button, I greatly appreciate it. And getting right into things here, quick disclaimer, I'm not a licensed financial advisor. I'm kind of just a retail investor. My degree is in finance. I enjoy looking into companies like this. This is purely for entertainment purposes. Disclaimer, I did enter a small position in this company. I think it's worth the risk. As always, there are risks associated with stocks. Do your own research, and that's it. Okay, Starwood Property Trust, a quick couple highlights. Leading diversified finance company, focus in real estate and infrastructure sectors. They have 350 employees, and they can also leverage their associated company, Starwood Capital Group's approximately 4,000 person organization. Portfolio is about $17 billion. Commercial lending segment has a loan to value of 61%, and it's pretty spread out geographically, definitely centered in the US, but kind of all over the US, and then in a lot of different sectors. We'll cover that. Floating rate loan portfolio, which will outperform in higher and lower interest rate environments, and they have a service segment which acts as a hedge to trouble in their lending segment, which we will cover in future slides. And they are focused on providing dividends for their investors. Currently it's lower than that, about 13% right now. Okay, this is a company that does care about its environmental and social impact. So you can see here they're big into affordable housing in their property segment. About half of their property segment is in multifamily homes. A lot of these are in Florida. So they're for low income earners. And socially, you can see big into diversity in the workforce, their human capital, and also lending to people who can't get traditional home loans. And then governance, they have won this REIT award, Investor Care Award, for like 7-8 years now, I believe. And that's basically for how good they are with communicating information to their shareholders and investors. So they have a great website if you want to do further research into this company. Okay. So here's a stock chart. You can see it took a huge dip when COVID hit. Their market cap, when I compiled these numbers, was a week ago. It was $14.81. I believe it's currently around $15, so up a little bit. Market cap $4.18 billion based on that share price, and 52-week high was $26.33. 52-week low $7.59. So it really took a cut when COVID hit. Beta 1.45, which just means it has bigger moves, about 1.5 times what the market moves on average. So you can see it's moving well below its 200-day moving average. Had you bought at the low 759, you would have had almost a 30% dividend yield. It's about doubled now, so closer to 13%. What are the analysts saying? They currently, Raymond James raised their target to $20.50 from $17.50. You can see the chart on the right. All analysts are rating this a buy or overweight. So that's what they are saying. Dividend, you can see the history since 2010. Um, since 2014, it's been 48 cents a quarter, which is $1.92 a year, which comes out based on the numbers. This share price I gave before, 12.97%. Trailing 12-month payout ratio, so I just took past 12 months earnings and divided the dividend by that and got 93.2%, which is high, but REITs are supposed to pay 90% out, so it's not as high as a normal company paying out a dividend like that. Ex-div date was 6/29/20, payment date was 7/15/20. They have not yet announced the next dividend. In regards to that, there's this quote, and this is Barry Sternlicht, the CEO, and he's basically saying they're going to assess it in June, which is past, and see where they're at with the effects of COVID and everything, if it makes sense for them to continue paying it. Personally, I feel that it's in the best interest and that they are likely to cut it, at least for a short time, but I do believe it will be reinstated, and they'll get through this, and therefore that's why I entered a position. I think that percentage dividend yield in the future will be worth it. Segments, they have four main segments: commercial and residential lending, infrastructure lending, property, investing and servicing, and we'll cover each of these. I'm not going to really go on this graphic because we're going to kind of break down each one, but if you want to pause it and look at it, feel free. Here's the portfolio breakdown. You can see commercial lending is the bread and butter. The servicing, investing and servicing, contributes a lot to earnings, which I think you'll see an increase because they're seeing an increase in activity due to loan modifications and forbearance and whatnot. So smaller percentage, but a lot of earnings, and then you can see where property, infrastructure lending, and residential lending fall. Okay, first segment, commercial and residential. I'm not going to go through this list of things, but those are the kind of loans that they an activity they are involved in. It's commercial lending and residential lending, usually to buyers who can't get the traditional home loans from other banks, and they do securitizations on those residential mortgage-backed securities. This is the largest and leading segment, 148 million to core earnings last quarter. No losses or impairments, well, practically none on the commercial side. They received 99% of the total interest due on the loans in April. Only one borrower didn't pay, and the credit quality is good with a rated average loan to value of 61%. So what that means is just their loan is 61%. Their loans on average are 61% of the value of the properties. So that's a fairly good rate. You don't want it getting too high. Closer to 100% is not as good. 95% of the commercial mortgage portfolio has adjustable interest rates. So obviously with interest rates low, they're not making as much money, but 90% of these do have LIBOR floors. I think that's how you say it. Basically, that's like a base that they earn, usually about 1%. And in the really, the Fed is not raising rates, not supposed to anytime soon. It maybe years and years before that, but if they did, then Starwood would benefit from this. Residential loan portfolio ended the quarter with 1.2 billion balance and loan to value of 69% and average FICO of 730. Okay, here's a snapshot of the commercial portfolio. You can see they're kind of spread out all over the US and about 20% international. And then you can see what areas they're in. They are exposed to hotel and office. That's part of the reason they took such a cut when COVID hit. So you can see those are the two biggest areas, but they're also multifamily, residential, mixed use, retail, industrial, and other. Hotel loans are only 12% of total assets today, and retail less than 2%. This is just for the commercial portfolio. Here's more of a breakdown of the commercial lending side. You can pause and look through if you want. You can see average loan to value, a lot of floating rate loans, and more of the breakdown on sectors and what type of loans. A lot of them are first mortgage loans. Property, this is our next segment. Acquires and manages properties, commercial real estate properties, contributed 23 million of core earnings for the quarter, and blended cash on cash yields of 14.6%. 95% of the rent from tenants was collected in April, so still pretty good. And that was starting to probably see more of the effects of COVID than right in March when it just started. Their Florida affordable housing has done very well, and then wages actually, median income levels increased in the area, which gave them the right to hike their rates by 5%, which they haven't done because they kind of want to work through the COVID situation first. But these rents have a floor; they can't go any lower. It's something to consider that the income level that they rent to probably will be hit the hardest with job loss from the COVID, from the effects of COVID. But it is supposed to be affordable housing, and with government assistance, hopefully they don't have as much of a fallout from it, but that's just something to consider. Okay, property segment overview. You can see some of the properties they own. They do have a little medical office portfolio, which they did say basically they just stopped paying on those while they were out of business from COVID, but they're expecting to start getting payments on those again. It's a natural inflation hedge because they do typically appreciate, and sometimes they will sell these properties when they appreciate and capitalize on those gains. You can see 98% occupancy, 109 properties owned. Next segment, investing and servicing. So they own a subsidiary, LNR Properties LLC. It's the largest commercial mortgage servicing firm, and basically, I'm not going to go through this list. You can read if you want, but they the reason it acts as a hedge is because when people look for loan modifications or forbearance, they're servicing and they collect fees for this. So core earnings of 35 million from this segment in the last quarter. The CEO mentioned it once made hundreds of millions of dollars before they acquired it. They said it hasn't been busier in the 7 years they've owned it, 7+ years. So that's something to consider if things did get really bad. This is a good hedge, but it also means that their properties, like with the hotels and retail, would not be doing as good, but at least they would be collecting fees in this sector. They did sell retail-heavy commercial-backed securities to reduce their non-investment grade CMBS portfolio from 10.5% of assets to under 5. Last segment, infrastructure lending. This is like lending in energy. Core earnings of $6 million to the quarter. No credit markdowns, no rating decreases. They collected all the interest last quarter. The loans have a lot of protections and covenants in there to protect them. 3/4 backed by natural gas and generation assets, and the rest are by pipelines and wind farms. They started this when they bought the debt business of GE back in 2018 for $2.56 billion. Currently, the portfolio stands at $1.6 billion. The GE loans are $687 million of this amount, 64% decrease since they acquired it. And just last week, there's an article out. They are looking to potentially sell off this segment of their business. So it got me thinking. It's either they see other opportunities and want to take advantage of them, use that cash, or they're maybe tighter on cash than they thought they might be, and they're selling it for that reason. But as we'll cover, they do have other resources to tap for liquidity. So I'm not entirely sure, the reasoning for them selling this off, but that's just something to keep in mind. Here's more on that. You can see they're in renewables, midstream, which is like oil, a segment of oil, thermal, natural gas, and mostly based in the U.S. Average loan size 46 million, over 34 loans. Floating rate loans, majority, and about 5-year average life, and 100% of them are senior secured notes, which is a good thing. Some business highlights: core earnings of 55 cents per share, GAAP loss of 24 cents per share. We'll kind of cover that in a second. Undepreciated book value, $16.94. CECL is like a new accounting standard they just adopted, and the mark-to-market is basically valuing the properties they own. Both of those really affected their earnings. 90% of, as we covered, their loans had a floor. Liquidity, $870 million of cash plus approved undrawn debt capacity, another $1 billion plus that of other liquidity that they can tap into. Financing facilities, they did pay down on their warehouse lines, which are just who lends them money, in order to receive about 6 to 9 months of basically, I guess you could call it forbearance for them to where they don't have to make any payments, and push it out to about $2 billion of payments out to 2020 to give them time to work with their borrowers and kind of figure things out. Excuse me. Credit performance, we said loan to value 61%, and you can see all the segments were collecting the majority of interest. Okay, so earnings, as I said, GAAP earnings were negative 24 cents, while core earnings, what they consider their true earnings, were 55 cents per share. The reason, you can see the quote here, CECL and GAAP, which they just really marked down what their properties were worth, which really affected their earnings. You can see resulted in a 70-cent decrease to GAAP earnings, 17 from CECL, 53 cents from mark-to-market, an 87-cent decrease to book value per share, 29 cents from CECL, 58 cents from mark-to-market. Some key ratios. I don't know I put this slide here, but trailing 12-month PE, I just took trailing 12-month earnings and divided the share price, $14.81, got 7.19. Price to book, 80.87. So below 1 means it's technically trading less than its worth on the book. While it's technically a good thing, a lot of times that shows investors are discounting the company for a reason. They're worried about something, so something to keep in mind. Debt to equity of 2.7, excluding the variable interest equity VIEs on the balance sheet. Average of 3.5 for REITs, so the debt to equity is better than average. Interest coverage ratio of 2.3, so that's decent. It means they can pay their interest obligations 2.3 times over. Okay, I'm not going to go too deep into numbers, but I put some screenshots of them if you want to pause and look at them. Revenues for the past 3 years, you can see, have increased, not a ton in the last year, but you can kind of see too the breakdown by segment. Here's the quarterly earnings, revenues, and net income, and you can see where a lot of the losses are coming from. If you look at change in fair value of investment securities, you get the big negative numbers. So that's really where a large portion of gain and loss on derivatives, derivative financial instruments. Here we have so core earnings, like I said, is what they consider their true earnings, 55 cents per share. Cash flow, I couldn't actually find a true cash flow statement in their releases, but I found this on a website, and So I'm not entirely sure the accuracy, but um, based going off this, and I believe this is pretty accurate. It does look like they do have some cash flow issues at times, but the trailing 12-month it is positive, and it will take a hit with slowed loan payments, but hopefully the investing and servicing helps to kind of offset some of that and get more cash running through the business. Balance sheet. You can pause and look at this if you want. We'll go over the capitalization here. You can see the majority of the company is back capitalized by secured debt. The rest is unsecured debt, and then equity market cap. Capitalization overview. You can see interest coverage ratio we talked about. So their corporate issuer rating is Ba2, double B minus. So that kind of gives you an idea to the risk profile of this company. There is there is a good amount of risk to this company just because of the sector they're in with the times being considered. So just keep that in mind. Total unencumbered assets of 3.3 billion, which are just assets with no claims on them. You can see there on the right the adjusted debt to equity ratios. Corporate debt maturity schedule, you can see nothing now due in 2020. They pushed all those payments out. You can see a lot is due in 2021. Something to keep in mind that if they're really struggling, they're going to have to further move those out or raise additional capital to meet those payments. Liquidity, 3.3 billion of unencumbered assets, as we said, 870 million of cash and approved undrawn debt capacity, well over $1 billion of additional liquidity available. So the ways they can tap into this, they can sell their property portfolio for over $1 billion. Obviously, they don't want to do that. They could harvest gains on their foreign exchange hedges. It would be 50 million. Sell their LIBOR floors north of 100 million, and then they have other unencumbered assets north of 100 million. So they really do need cash. They can tap into it. Undrawn debt capacity of 8.6 billion, and that's after first quarter dividend payment and 253 million of deleveraging across our facilities. So that's how we said they paid down their warehouse lines to receive that 6 to 9 months moratorium. They are trying to kind of balance taking advantage of opportunities and keeping cash to weather this crisis. So it's kind of a hard thing to do, but they do want to take advantage of mispriced loans and properties. So they do have no plans to raise debt or equity capital currently. They said unless they see a very attractive opportunity. Book value per share, this is what they feel. Their book value per share is $19.65, which sitting at 15 is quite a bit under. And this is still related. They mentioned, GAAP earnings really affecting their book value per share. So that's just kind of what they feel their fair value per share is. Buybacks, they did approve a buyback program for 400 million. They purchased some in March, 1.9 million shares for about $29 million. However, when COVID started, they did suspend that, and they'd rather put that money to outstanding debt that is trading below investment grade. Loan to value, we said 61%, and that is via third party. That's near a 10-year low. The banks that lend to Starwood have lower exposure, so basically that means Starwood's not as likely to receive a margin call, which is a good thing. That's per quote from the CEO. If you look back, this is another quote from the CEO looking back to 2008. Loans similar to the 730 FICO, 66% loan to value portfolio that they have had less than 1% losses. So something to kind of think about and consider. They don't want to have to take back collateral, so they're trying to work with their clients, but that's kind of the last resort. Key risk: it's a volatile stock. Um, you can tell that by the beta. Uh, Decline in their fair value of assets. I think the worst, well, hopefully the worst is behind them for that, but that's why you saw their earnings, GAAP earnings were so bad. Default risk and slow payments. They know this is going to happen, especially in the hotel and healthcare sector. They said about half of hotel borrowers have asked for payment relief already. 60% of the book has asked for accruals. So they broke down the math. He said about 12.5 to 14% are going to get some kind of deferral, monetary deferral on their payments. So you can tell definitely that there's going to be less cash coming in, payments are going to be slow, and that's going to affect cash flow. But they did move out, their obligations to 28, 21, so hopefully that helps with that. REIT requirements may limit, what they can do, and in regards to hedging, taking advantage of opportunities and their tax liability. Timing of tax liabilities versus income realized. Spread widening between treasury yields and corporate debt yields, and a big difference in what buyers are willing to pay for commercial real estate and what sellers are willing to accept. I was reading an article on that. Basically, kind of buyers and sellers are just not on the same page on a price to pay. So if they did see a property they want to take advantage of that was marked lower, the seller may not be agreeing to sell at that price or looking to sell. Bonus pay. This isn't really a risk. It's just something I typically not a fan of, but bonus pay is not based on metrics. I feel like it's a good thing when the bonus pay of executives is tied to a specific metric, so they're not being rewarded unless the company's truly performing, but I just threw that in there. Here's the CEO, Barry Sternlicht. He has quite a bit of experience and navigated through a lot of past financial crises, and you can kind of read through here if you want. One good thing about the team, there's a lot of senior members, a lot of experience on the board, so something to keep in mind. Insider activity, that guy, Barry, he bought about $2 million worth of stock at $9.21 after that dip. The director, Starwood, bought some at $18.60 back in March. This was last year. CFO sold 13,000 shares at $24. You can look on the right, there's a chart of the directors and executive officers and their percentage and amount of shares. See, Barry has about 3.1% of the class shares, and other directors about 3.5%. So 3% is a fair chunk of the company to have your CEO invested in. So that is good. It's a fair amount for him to have tied up in Starwood. Institutional. It is a REIT, so you can see BlackRock and the Vanguard Group do hold a good chunk of the shares of this company. Here's some quotes I just thought were interesting or liked from reading the earnings call. You can read them, but basically, the first one, they continuously mention being in it for the long haul, not wanting to impress just for the quarter. They want to be, a dominant player moving 20 years and out. So that's something you do want to hear. They're not willing to sacrifice short term to just make the company look good. Second one, that's regarding a property that they were expecting to just break even after, when Dixie, they went into bankruptcy, and they didn't know what they were going to do with the properties, and then they had a new tenant sign. Based on what I was reading, it sounds like it maybe was one of the FANGs companies. They wouldn't say, but high quality tenant, and they're expected to gain 40 million on that if they want to sell it. And then last one, he's just talking about, relating it to the 2008 crisis and basically saying they're more of a commercial REIT, not a residential REIT, so they have different risk profiles, and when the ETFs go down, they drag Starwood down as well. So it might present an opportunity as they don't have the same risk profile as those other REITs. And I liked him saying, I'm beginning to feel like the Rodney Dangerfield of commercial mortgage REITs. We get no respect. So he has that kind of chip on his shoulder, which is a good thing for a CEO to have. Future increased staffing, other headwinds are going to decrease earnings in the near term, but should recover over time in the next few years, hopefully. You can see in the quote there, that's what they believe, but they can harvest the gains in their books, like they say they've always done, selling properties if they want, liquidating things. Originators, residential REITs, and banks. So people aggressively sold off loans when COVID first started, and that created a lot of opportunity that they can potentially take advantage of. More attractive returns on those. They are more they're more focused on the equity side. This was in response to a question from a reporter. They said they're more focused on the equity side, buying valuable assets cheap on replacement costs, as opposed to the lending side. And then the fees, as we mentioned, from the servicing side, 14 billion of loans over 500 bespoke loans will be realized over the next 18 to 24 months, so it's going to take some time for those to show. And these were all made since COVID-19. Okay, that is it, guys. Let me know in the comments below, what do you think? Are you interested in buying this? Do your own research, as I said. Do you think it's worth the risk for the dividend? Do you have any questions? Post them below. I can look more into something if you wanted to know. Also, post below if there's a company you want me to do the same thing. I'm going to try and do at least 1 to 2 a month, kind of a deep dive like this. And so post if you have any stocks you want me to look into below. Like I said, I'd really appreciate if you like and subscribe. Did put a lot of time into this video, but that is it. I will catch you guys in the next one, and thanks for watching.